Hi and welcome to NABTrade's end of financial year special. Today I'm joined by Anthony Doyle from Pinnacle Investments, which is a range of different investment managers, so lots of different views on how things are going and what you might like to think about as we come into end of financial year. Anthony, thank you so much for joining me.
Thanks, Gemma. Thanks for having me.
So exciting. You look now across, I mean, when you first started, it was always across asset classes. So you don't just go, this is equities, this is what you need to think about. You've got this sort of broad range of different opportunities and challenges for investors to think about. Complex time. How are you guys looking at things at the moment?
I think April really shook a lot of people, both from the professional investment community, but also direct Aussie investors as well. And when I say it shook people realised that they potentially had unintended risks within their portfolios that during Liberation Day and in the immediate aftermath, obviously sold off and potentially didn't do the job that they thought that these exposures within their investments would have done. So what we're really seeing in that post-Liberation Day carnage when markets sold off and then rebounded very quickly is a lot of investors questioning their current allocations. They've let some allocations run for a long time, particularly post-COVID and that revenge spending that we've seen, and particularly since we've seen the development of AI and the Magnificent Seven, for example. So investors, I would say, are really performing maintenance around their portfolios. Where are exposures that I can potentially build those diversification benefits in a world where volatility is higher? And we expect these volatility sell-offs to become more compressed and more frequent given the current geopolitical environment.
That's such a polite way of putting it, which is somebody tweeted and crazy things happen and we have to be ready for it. I will say for NABTrade investors, a huge book of cash on the sidelines at the moment. And we saw people buying aggressively. Liberation Day, for anyone who missed it, was the sort of Trump tariff announcements en masse. There were lots of them. They come out sporadically, but there was one big day of announcements, and that was what really rocked the market. Our investors, the day after that, when the market started to really sell off hard, were buying aggressively, and then they've seen this bounce back, which is a real challenge, right? We're like, I've had a good time, I've made lots of money, but now everything looks quite fully priced again if I'm looking at US equities and potentially Australian as well. Heading into end of financial year, good time to review your portfolio, good time to think about whether or not you should trim some things and maybe allocate. But this cash is interesting. Lots of cash to deploy. When you look across the range of asset classes that you can now talk to and the range of different things investors might consider, where would you think about maybe deploying some cash?
You don't often get two bites at the cherry, Gemma, and it sounds like NABTrade's investors did absolutely the right thing. And what we saw in that immediate aftermath of volatility was it was typically levered players in the market, hedge funds, algorithmic trading, programmatic trading. The robots were very much selling en masse. Whereas when I spoke to the portfolio managers within Pinnacle's affiliates, so we've got 18 boutique investment managers under the Pinnacle umbrella, overwhelmingly, the professional, real money, long-only investors were also looking to deploy capital at that time as well. So we had a similar view. And as you say, markets have rebounded very quickly and the outlook is uncertain. There are a range of plausible outcomes from here. So when I say you don't often get two bites at the cherry, there is an opportunity today to potentially think about those exposures within your portfolios that have performed very, very well, and think about harnessing the benefits of, firstly, diversification and taking a long-term view. So the big themes that have run really hard are US over the rest of the world, growth over value, large cap over small cap, DM, developed markets over emerging markets. Thinking about potentially adding a couple of % here or there in some of those asset classes that from a valuation perspective look very cheap.
Yeah, interesting. Do you want to call out any specifics for us? You might actually want to talk to the managers that you represent as well, just a couple of the names, because people will be familiar. So we have had quite a few on our podcast. You've been on our podcast many times, and videos and so on as well. Yeah,
so from a growth perspective, for clients, for NABTrade's clients that are looking to develop portfolios over time and have potentially a longer term time view, we're seeing a lot of demand in our stable for the Plato Global Alpha Fund. as that core global equity allocation. So it was recently listed on the ASX, run by a portfolio manager, Dr. David Allen, that has run these successful strategies offshore in London as well for a considerable period of time. On the value versus growth side, a value manager within our stable is named Antipodes, and they've performed exceptionally well during April. So when I say, we're seeing some rotation towards value, Antipodes have very much been in demand in terms of their product that's listed on the ASX. And when you think about the companies, those Magnificent Seven type companies, from a growth perspective, we have one of the best managers in the world named Hyperion, and they have a fund on the ASX, an active ETF called the Hyperion Global Growth Fund. These are the types of companies that, my kids, they're 9 and I've got 7-year-old twins. These are the companies that you buy and you own forever, and they just compound their returns at 20% a year forever. And they're the Mag 7 of the world, but also quality growth type names like your Costco's, your Visas, your Hermes, your Louis Vuittons, for example. They have dominant positions within their sectors, and it's very hard to usurp them in terms of their business models. So that's from the growth perspective. I've talked about value, I've talked about growth, I've talked about core global equities. From an income perspective, very much our private credit offering, which is Metrics. They have a couple of listed investment trusts on the ASX. Huge demand for the income that those products are generating, sort of 10, 11% income profiles, and lending to businesses in Australia. And in a world where interest rates are coming down, economic growth should be stable or even improving. So it bodes well for private credit and fixed income.
Any final thoughts to leave investors with as they're just thinking about how they might just reallocate coming into end of year?
Yeah, it's modern portfolio theory. So bear in mind what your risk tolerance is. Bear in mind what you seek to achieve from your hard-earned savings. Think about your investment goals, your long-term investment goals, and don't get caught up in the noise. Remember why the media exists. It's to sell advertising. That's their business model. And behaviourally, the way that they can attract our attention is to be as negative and as extreme as possible. No one essentially reads good news. They want to read bad news. And that's how we evolved off the plains of Africa. So cut through the noise, come back to your core philosophy, your core tenets of why you are investing, which is to save for a long-term investment goal, whether that be a house or your retirement, and take a long-term view. Often these periods of drawdown in growth assets, like equities, like stocks, can represent a fantastic opportunity to enter into these positions and build your portfolio for the long run. So it can be very exciting despite the volatility that may emanate out of binary events like geopolitics.
Anthony, thank you so much. Amazing wrap up.
Cheers, Gemma.